Hello and welcome to SwitzerTV Investing. I'm Peter Switzer. On this week's show, we shine the spotlight on 8 stocks in total: CSL, Altium, BHP, Telstra, Nuix, and Centuria Industrial REIT, as well as a couple of mystery stocks that our experts will throw in. Now, looking at these stocks, we have Julia Lee from Berman Invest, who will look at these stocks and pass judgment and give us her favourite stock that she's buying right now for her fund. Adam Dawes from Shaw & Partners will give his views on these same stocks as well. And then Mike Gable from Fairmont Equities will see what the charts are saying about these companies' futures, and Mike will throw in a company he likes right now based on the charts. Finally, Paul Rickard looks at ethical funds at a time when the world is getting really serious about ESG, which is the ethical, social and governance attitudes of the companies we invest in. But how do these ethical funds actually perform? Paul will give us the update on that. So let's kick off with Julia Lee from Berman Invest. Well, joining me now, as she always does at this time, is Julia Lee from Berman Invest. Hi, Julia.
Hi, Pete. Great to be here.
Julia, we've got a few stocks I tossed your way, and you've got a mystery stock that you like. I think I described it as your love child stock, the one you're in love with at the moment and you're buying. So we'll save that one to last. Let's kick off with the CIP, Centuria Investment REIT. What do you think? Industrial REIT.
I mean, looking at the specs of this fund, it looks really good. I mean, industrial property has tailwinds at the moment. The 3 largest tenants are tenants like Telstra, Arnott's and Woolworths. And, you know, industrial property has been growing. The only thing here, I think, is that the property trust sector has been under pressure. We have a look at the property trust sector. It's down 4% in the year to date. And a lot of those property trusts have been falling. I mean, if we have a look at Charter Hall shares, that's down 20%. Waypoint is down 12%. And even Goodman Group, which is the darling of the sector, is down 11% in 2021. And the reason for that, Pete, is really because of what's happening in terms of long-term bond yields. We're seeing long-term bond yields rising, and that's having a negative impact on those interest rate sensitive sectors like the property trust. So while central industrial property does look interesting, because of bond yields, I'd say I'd be pretty neutral on this at the moment. Having said that, if we have a look at its net tangible asset backing, it's at $2.99. So if it was to dip significantly below that, 5% below that, then I would be a buyer because that would signal that it's very cheap. But at the moment, the rising bond yields is a headwind for all retail investment trusts, except for those, of course, exposed to shopping centres, which are one of the few real estate investment trust areas rising this year, where we have seen stocks like Essentia, Stockland rising on that reopening trade.
Okay, let's go to BHP.
Well, BHP has pulled back a bit ever since it traded ex-dividend. We've also seen the same from the likes of Fortescue as well as Rio Tinto. And one of the things that we have seen is iron ore pressures pulling back from those record prices. What we've seen in China is that they have closed down the main steel-making city for 4 days because of really bad pollution, and that's impacting on the short-term pricing at the moment. Having said that, I'm very positive on the second half of the year. I think that China's still aiming to grow up more than 6%. We saw some numbers coming out of China, and industrial production, retail sales were much higher than expected, and we're actually accelerating from the December levels. So China's still looking relatively healthy, and of course the rest of the world is going to play catch up once those vaccines are rolled out and it's business back to usual.
Okay, let's go to Telstra. Now, I know you and I liked it when it was around $2.75, $2.80. Struggling a bit at these levels. What do you reckon?
Yeah, I still like Telstra at these levels. I think it's worth at least $3.80. And I think that the way to think about Telstra at the moment is all the bad news priced in? Has earnings bottomed out, and will it improve from this point forth? And I think the answer is yes. Through COVID-19, we did see sections of its business being impacted negatively, We, of course, couldn't travel, so global roaming was impacted negatively. But in September, they saw a hike to their mobile rates, and that should be a positive. And then, of course, looking to sell off those exchange towers as well to monetize some of the assets that it owns. So that should be a positive for shareholders as well. So I think it's trading around about 310, 315 at the moment. I do think Telstra shares are worth more around the $3.80 mark. And importantly, I think earnings have bottomed, and in the second half, we'll see more of a normalization in terms of earnings. I think one of the positive things that came out of Telstra's half-year results is that we did see things going backwards, but they did keep their dividend flat, and I think that's a sign of confidence that we're going to see a bounce back in the second half.
I was tipping $3.50, but I'm really happy you're going for $3.80. Let's go to Nuix now, and the analysts reckon about 85% rise on Nuix. It's gone up enormously and then it fell enormously. What's your current position on Nuix, NXL?
Sure. Pete, one of the things I love about the market is that there's overreaction on the upside and the downside. And the half-year numbers for Nuix, which was a maiden result, were disappointing, and the market simply punished this company. In fact, the share price fell below the IPO price of $5.31, even though Nuix kept its full-year forecast the same, which to me signals that it's quite confident in its second half pipeline that things are going to bounce back relatively strongly. So look, I think in the second half we will see things bouncing back strongly. We have a look at what Nuix does. It looks at sifting through a huge amount of data using things like artificial intelligence, and it's used by areas like the ATO, ASIC, the federal police to try and investigate huge amounts of data. So look, I'd expect earnings for this particular company to grow around about 10 to 15% a year. I think the sell-off has been overdone, which means I think there's still opportunities at these levels.
Okay, let's go to Altium next.
Sure. Altium is all around printed circuit boards and the software design of the software to design those printed electric circuit boards. And of course, these are used in all the things electronics that we know, and it's used to connect different electronic parts. I think the main concern with Altium for me is the margins. Margins have been declining, and look, Altium does have a 3-year turnaround plan to try and get those margins back up. But I think in the short term, those margins are going to come under pressure, which means that the share price is also at risk of coming under pressure here. So look, I'm neutral on Altium. It's an area that I think will continue to grow, but I think importantly, we need to see a stabilization in those margins at a much higher level. And of course, the disappointing part of Altium's results were those margins. So look, they have a 3-year turnaround, but a lot can happen in 3 years. So I'm probably a little bit cautious, but rated neutral on Altium.
CSL.
CSL. The key for shareholders now is whether earnings has bottomed out in terms of CSL. Of course, at the heart of CSL's business is its blood plasma business. And because of COVID-19, they haven't been able to collect blood. Over in the US, they used to pay people about $700 for their blood. Now I think they've increased that to $800. But the other thing to remember with CSL is there's around about a 9-month lead time from collecting that blood to selling that blood and somebody using that blood. So that means that, look, collections are still not back to normal. Yes, we are seeing vaccines being rolled out in the US, and over the next 6 months, things will get back to normal. But because of that 9-month lead time, it means there's likely to still be disruptions to its business in the next financial year. Having said that, this is a reopening trade, and if you have a more than 2-year time frame, well, you'd expect that it will be business back to usual in around about 2 years as hospitals go back to their normal business. We travel, we go have accidents as per normal as cars are on the road. So CSL, I think, really is a reopening trade with a bit of a lag because of that 9-month lag from collecting the blood to
Okay, on the subject of reopening, you're flying high with your preferred stock.
Oh, I like Qantas. Travel at the moment, I think, is a real coiled spring because, you know, we're itching to go on holidays. I'd love to go on holidays, Pete. And so when I think things normalise, there will be a lot of spending in terms of holidays. And if we're all spending money on holidays at one time, well, prices will go up. And that means nice margins for travel companies and travel-related companies. Qantas, I think, gets an extra boost because of the federal government subsidies that have been announced to the travel space, which means that I think travel's going to be actually higher than the pre-COVID-19 levels. There's already, I think, travel demand that's like a spring, and then add in those federal government subsidies, and it's party time at Qantas. The other thing is that it is in the midst of a 3-year cost-cutting program. So that's just an added bonus for shareholders at a time when demand is bouncing back strongly, that it's looking at being lean and mean as well. So look, Qantas, still a buy at these levels. It's still quite a substantial amount below those pre-COVID-19 levels, and I think it's going to do great over the next 18 months.
So when you think about it, they have less competition from foreign airlines because people are flying domestically, and the people who want to go to Europe are going to Port Douglas or Cable Beach or whatever, places they haven't been to before because they've been flying overseas. So it probably is really good for Qantas. You're absolutely right. Julia, thanks for joining us as always. Talk to you next week.
Thanks, Pete.
Well, joining us now is Adam Dawes from Shaw & Partners. Adam, how are you?
Really well, thanks, Peter.
Very
Yourself?
good, mate. Now, the market did sneak up after being in the red for most of the day. What's your take on this relationship between the bond market and selling off tech stocks?
Well, look, the bond market, we always know, seems to be where the smarter money potentially might go. However, equity markets do get concerned when bond markets start to rally because they probably think that we don't know something, or bonds know something about something else that we don't know about. So I think the relationship has always been a tough one, because if bonds are starting to rally equity, that means equity markets potentially should come back. But I really don't understand this whole tech sell-off. I get the idea of there needs to be some value, and the market's looking for those kind of value stocks. I get that. I understand that. However, a lot of these tech stocks have rallied hard coming out of COVID because of the numbers that previously happened. Market's now looking for where the value is. But I don't get why we're afraid of inflation. I don't understand why we're worried about these things, because that is what happens normally when markets recover. You get a little bit of inflation. You start to get interest rates starting to rise, and this is a normal part of a recovery cycle. So I'm just a bit scared. I think the market's probably a little bit too skittish at the moment and just needs to calm down a little bit.
It just seems to me that we'd have to have a significant rise in interest rates before it was really worrying for a company. And by the way, rising interest rates could also coincide with massively high sales and really big profits that would counter any slight rise in interest rates.
Agree. And, if that's a normal part of what happens in a recovery, fantastic. Let's bring it on. We want this market to recover. We want the world to recover. And we go through another cycle. And maybe that's it. Maybe it's just part of that interest cycle of a larger cycle that everyone's just going to have to get used to.
For sure. I've asked you to look at a few stocks. The first one is the Centuria Investment REIT, CIP. The analysts think there's 12.8% upside of the company like this. What do you think?
Yeah, look, I think that they've certainly got a lot more capacity on the upside to this one. And Centuria Industrial REIT, look, it's a really good one. I like the Charter Hall Long WALE REIT also. The WALE REIT offers a little bit of a better bond sort of proxy exposure, which we're just talking about bonds. While I think Centuria Industrial REIT offers a really good exposure to industrial property that has some really solid tailwinds. Now, industrial property is all about those moving packages backwards and forwards. All of these kinds of things where we are doing more shopping online. We are doing that kind of stuff. And there's a really big group called the Milestone Logistics group that is about to IPO. And that's going to give, I think, Centuria a bit of a run for its money going forward. But I think there's some significant upside relative to their book value at the moment. And I think that their debt capacity is sitting at 30-40% target. I think that's fine. The gearing's looking good. So, I really like this one. I think it's got a lot of tailwinds at the moment.
BHP, the analysts only think 0.2%. I must admit, I thought around $40 was where it was going to max out, but it's kept going up. And I hang on to my BHP just for the dividends, but I'm getting the double whammy. Do you think there's more upside for BHP and Rio?
Well, you're right. I mean, every time it got to $40 over the last 20 years, it would get smacked down. You know, we had the buybacks at 42 a couple of years, well, many years ago now for those people at home that have got a good memory. But yeah, like BHP is definitely, every time it hit $42, always came back. I think this time, obviously, we're seeing iron ore price at all-time highs of $140, $160. That's definitely helped BHP. I think the dividend was a fantastic dividend, and people are looking for income at the moment. So there was extra buying going into that. I think it's sort of around that sort of 48.50. I mean, coming back a little bit now, I think there's probably no real reason for the traders to hold this stock. I don't think that you need to have it. But for investors like you and I'm not going to be selling it. And I think it's going to continue to go on. So I really like it. And then they've got the copper story, which is all playing into their hand as well. So there's some good tailwinds, not headwinds, tailwinds for BHP.
And there's never been a boom like this, you know, in our lifetime. I think what we're going to see is 6 or 7% growth in the US. So, yeah. Okay, let's go to Telstra now. Analysts think 14.1% upside. What do you think?
You know, we had Telstra in 2 weeks ago, and it was the first time in 5 years that they actually came out with, we think we're going to be profitable this year. We are actually going to get some numbers that are actually looking good. And they all walked in with a little bit of a skip in their step. It's not about what they say, it's about how they look sometimes. And they actually walked in with a bit of a skip in their step. I think people are right. I think we've seen the cycle of the downward move on Telstra. I think that they have obviously got the market power, but also that dividend I think is going to rise. I think for one now that they are going to start to sort of hive off some of their businesses. So the telecom towers, they'll start to move. They'll simplify the business a little bit. And I think that's exactly what they need to do. It's been too big for too long, doing too many things. But I was really impressed 2 weeks ago. I've started to buy some Telstra down here. I think it's a buy.
Okay, let's go to Nuix. NXL was a darling of the market with a fantastic reaction to its IPO. Then it really went for a big slide. Analysts think about 85% upside. What do you think?
Well, they have to probably. They're all long at $11 or something, aren't they? So, look, I think Nuix is an interesting one because it's data analytics, and I think that's the biggest thing with this one, is that they have some really good structural growth in data forensics, and that's driven by litigation trends, surging data usage, corporate surveillance needs, those kinds of things. Nuix fits in beautifully with that, and they've got a really good competitive advantage that goes across some of their competitors, and they can do some amazing things with some of their data that they've got. However, I think that the stock had been overbought up there at a sort of $11 plus, and I think it was definitely oversold down here at $5, $6. So I think there's something there. I think the second half is going to be quite good for these guys. I think you start nibbling down here. It's obviously had its run. There's a bit of digestion going on. So any kind of price rise, I think you're going to see some selling off going forward. But the stock has really moved. It does have the ability to move into a software as a service and expand into new verticals. So I really sort of like that. But really, at the end of the day, my rule is if it does go above IPO, but then dips down below and then comes back again around that IPO price, it's a buy. So I'd happily dip my toe in the water on Nuix here.
Okay, let's go to Altium Alu. Once again, analysts positive, 29%, they reckon.
Yeah, so I'm a little bit cautious of 2021 with Altium. Fantastic business, don't get me wrong here. Fantastic business. But I think for the remainder of 2021, I'm a little bit cautious. Despite obviously they're discounting a little bit less and they've increased their prices, but a weaker US dollar is not going to help, or is going to help them, but a stronger Aussie dollar is not. And I think that's why we're coming a little bit unstuck here in the healthcare sector, and as well as some of these US denominated tech businesses here in Australia, is that our Aussie dollar at 77, 78 potentially can go a little bit higher. I think that's going to put a little bit of downward negative fall on their revenue, as well as the way the market is going to look at this one. I expect, obviously, that Altium is going to do well with the vaccine rollouts, all of that kind of stuff, and faster than expected to monetize some of their cloud platform businesses. And I think that is something where I'm just cautious. I think this is a 2022 story, to be honest, Peter. And I think you got time to wait on this one until all the negative guys are out there. The stock moves in a sideways direction, and then can move higher from there. So I'm happy to sit back for the next 3 to 6 months and see how this one goes.
Finally, CSL.
Well, it's been hit pretty hard, hasn't it? We all love it, but it's been hit pretty hard. Again, it's an Aussie dollar story. So as the Aussie dollar continues to climb, CSL is going to have a little bit harder time to go for them. We had CSL in about a week and a half ago. We see them as a really good defensive business, and healthcare has probably one of the best TSRs, which is the total shareholder return. So this is the healthcare sector, has one of the best TSRs in the market at the moment. So certainly CSL is up there. Just seems to trade in a bit of a sideways pattern here and sort of broke that 275 and sort of now coming down a little bit. So look, I think, the only thing that I noticed about CSL was when they've got blood collection areas, where if you've got COVID, it's going to take time for those blood collection deposits to come back in. And so we've probably got a 6-month lag as to that collection opening up and then people coming back in, and then hence revenue for CSL. Again, I like this business. I think it's great. Aussie dollars is probably, if it starts to come off, you buy this thing. But look, it's one of our best blue chips on the market, so it's a buy.
Thanks for joining us on the program, mate. Talk to you in a couple of weeks' time.
Okay, take care.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, I'm catching up with Mark Gable from Fairmont Equities, and Mark looks at a lot of the stocks that our subscribers and viewers are interested in, and we get the technical outlook for where these companies are heading. Good to see you, Michael.
Thanks, Peter.
So, mate, let's kick off with BHP first of all. A lot of people have been inquiring with us. I must admit, when it was around 38, 39, I wasn't recommending people to buy. I was definitely hold. I was happy with the dividend outlook, but it's kept going up. What's the chart saying? It looks pretty positive from here.
It does. So, I mean, as you know, or as our viewers know, I've been positive on commodity stocks for, for a while now, for several months. BHP's trading very well. So the chart that we have on the screen here is a monthly chart. So what I wanted to show everyone was the fact that if you look back far enough, you could see that what it's done is there has been a bit of a lid in the share price around that sort of $42, $43.
Yeah, that's where I was a bit resistant on saying, that looks pretty good to me, but go on.
Yeah, and what it's finally done, as we can see, is it's popped through that. It did so in January, which is a positive sign. End of January looked a little bit precarious, but now it's kicking on. So although shorter term it looks like it's made a lot of headway, when you zoom out and look at the monthly chart, you could see that for it to break a level that's been quite significant for, let's say, 14 years or whatever it is, I mean, that should lead to quite a sustained rally. So the fact that it's gone up for a couple of months, I think is only the start of it. Look, I think BHP's got a lot further to go.
And one thing you can throw into the mix to maybe explain this is, in all the time, even when we went back 20 years, we're not going to see the growth that we're going to see this year and next year as a consequence of the stimulus that's followed the coronavirus. So it makes sense that if this company's going to make an all-time record high in share price, it's going to be in the context of unbelievable growth. Yeah,
exactly. And I guess the one caveat that we do have to mention is that, resource stocks are cyclical. So let's not fall in love with it and think that we're going to hold it for 5 years because, the run might be over in 7 months' time, it might be 2 years' time, we just don't know.
When Brazil and Vale can get back to normal production, there might be a supply reason to bring it down, but they still seem to be in a fair bit of trouble over there in Brazil.
Yeah, exactly. But for the moment, the momentum's there. And look, if you can get BHP on a dip, I think it's worthwhile.
Yeah, okay. Let's go to the next one now. This is CIP. Not a lot of people know this one, but Centuria's industrial REIT, isn't it?
Yep.
And I should say that BHP, the analysts only think there's 0.2% upside. They're not as confident as you.
Yeah.
But CIP, I think, is about a 12.8% upside. Is the chart justifying that positivity?
Potentially. So, look, I think industrial property is a good space to be in. As we know, Goodman Group's done really well since the COVID lows. CIP, what I'm trying to highlight here is the tightening of the range, and I guess I suppose I come back to the same sort of chart patterns each time I look to buy something, and that's a share price range which starts to tighten up, volatility starts to drop off, and then eventually you get a breakout. Hopefully it's in the direction you want. You follow it, you get a decent move. So here we could see since the June high, it hasn't really gone anywhere, but there is a clearly defined range, and it is starting to tighten up a bit. And look, maybe it breaks out in the next few weeks, maybe it takes a few more months, but I think if you like CIP, look, don't rush into it. There's probably other opportunities elsewhere, but keep an eye on it. That top diagonal blue line, all you need to see is a proper push through that, and that'll tell you that it's game on, the money's flowing in, and you can get a bit of a decent rally.
What's interesting, Michael, is that these industrial REITs did well when people started to work out everyone's buying online, and therefore the warehouses that stock them are going to do very well. But this was a $3.70 stock before the coronavirus. Now, I would say the demand for their space is actually bigger now as a consequence of the coronavirus, and the fact that there's a whole lot of people out there who never bought online who are buying online now, even if they buy less than they did during the coronavirus times. They're new consumers and customers for these organisations. So I think looking at that also, we tend to be trying to go up, even though it's on a decreasing trend. The lows don't seem to be as scary, but maybe I'm being wishful.
Yeah, look, too early. I don't want to rush into things, but one to keep an eye on.
Yeah, okay. Next one, a lot of people have in their portfolios, or maybe think they should have, namely Telstra, TLS.
Yep. So look, Telstra is one of those companies which, I've never been a fan of. And I mean, we can see what I've tried to show here is the weekly chart going back several years, and we can see it peaked in 2015 and it's trading at less than half where it was then. So it's another example of investors, unfortunately, they chase the yield and they end up losing more from the capital than what they get from the dividends. So look, long-term downtrend. It hasn't gone any lower than that low in 2018. But what I've tried to highlight here with those arrows on the right-hand side is the fact that it is starting to form these lower highs. So every time it rallies, we do see some selling. So not very compelling for me. Look, maybe at some point it gets going and there's a bit of share price.
I'm expecting it to go through the roof.
No, I mean, if you think about the business, their earnings growth, I think the only positive is, okay, maybe if they split up part of the business, you might unlock a bit of value. But, I mean, how much can you really unlock? I mean, you look at that chart, you could see that, again, selling every time it tries to rally. So I just think that it's not, you don't need to be there.
I think a lot of people who watch this show might have got in when Julia and myself thought around 275, 280 was a reasonable time to get in. And I think it got up to about 320 or something.
Yeah, we've made some good money if you did that.
But it's just, I think a lot of people would love to see it make it 350, but looking at that, it might be a hard press to do so, unless there is a change of information that we haven't got in the market right now. Let's go to the next one. This is an interesting one, Nuix. It was unbelievable. It's NXL. It was doing unbelievably well, and then it got smashed with all the tech stocks. But I've got to say, the analysts think there's 85.3% upside. Now, what's the chart telling you, Michael?
As we could see, it's a recent listing, so there's not too much to go off. But normally with these IPOs, sometimes you do see a bit of selling come in straight away because people have picked up the shares pre-IPO and they're looking to exit.
So very normally, unloyal people who are probably looked after by the founders. Yes.
So look, I think the way to play these is just, if you're still sitting on the sidelines, I think you just wait. You just let this sort of flow through. You let all the selling happen and let them do what they need to do. And eventually, what you might find with these IPOs, sort of 6 to 12 months in, you might get a bit of a base forming where the quick sellers are gone, and hopefully there's a bit of a base and you can step in. So I think it's early days. I mean, for me, I couldn't be buying it just yet. Obviously, if it's a great business, I think you just keep an eye on it, and we just hopefully see it, plateau for a while, and and then it sort of gets.
So you're saying, let's see if it plateaus around this $5 mark, and with an inclination to be going up more than down, and that could be the starting point. I often say, Michael, I don't know what you think. When you get a stock like this that once was around 11, nearly $12, but I think intraday might hit 12. But the bottom line is, you said then, it is a good business. Even if you miss the first 5% of an upside, it's probably you're probably worthwhile waiting to see the market take that 5% before you start getting.
Yeah, exactly. And I mean, we've got there's a lot happening in the market at the moment with bond yields and this debate around whether there's a rotation from growth to value and so on, and is it going to stick or not? So I think we just let it play out, because at the end of the day, I can give an opinion on what I think might happen, but I don't know what's going to happen with the bond yields and all that. So I think we just wait and let the dust settle, and hopefully it ends up like an end of 2018 story where we got a little bit worried about nothing, and then things kick on. And
the bottom line is your strength is when you've got the history, you can actually make some suggestions around that history, but there's not enough history there. This one. Let's go to the next one now. This is James Hardy, JHX. So what do you see in this company? Looks pretty good from my amateur point of view when it comes to tech analysis.
Yeah, so look, long-term trend since the March lows, eased off since it peaked in November, and that's starting to kick on again. So look, I think this is one that is just resuming an uptrend, and it actually looks like a good buying opportunity here. Okay,
let's go on to the next one now. If my wonderful producer, there he is, CSL. Now, this is you and I both would agree, one of the best companies in the world, but it's having a few challenges at the moment. Are those challenges over yet?
So what I thought I'd show here is a weekly chart going back 5 years. And what I've indicated with the arrows is the left-hand arrow is the March low during COVID, and obviously CSL's back at that level. So I think a lot of people have picked up on the fact that it's back at those COVID lows, which is a potential opportunity. We can call that potentially a double bottom in an uptrend, which is very bullish. So I think there's a lot of reason that CSL could rally from here. The other thing to bear in mind is, I mentioned earlier the 2018 sort of hissy fit the market had because of rising bond yields.
And also the China trade war, Trump and carrying on,
So if we recall back to the end of 2018, and we can see in the middle of the chart here, CSL lost about 26% of its share price because the market was worried about bond yields going up. And as we know, I think it was around Christmas Eve, we heard from the US that no, bond yields were not going up.
Interest rates was basically headlocked by Donald Trump, wasn't it? Come out
exactly.
Say, no, interest rates aren't going to rise.
So when the market knew that yields, interest rates were not going up, we could see that CSL actually rallied 50% during 2019. So similar situation here, from peak to trough, CSL's lost about 26%. It's at the March lows. If we realise that bond yields are not heading up at a great rate of knots, then you might get a repeat of 2019. Otherwise, CSL might just have a bit more weakness. So again, I don't know what's going to happen over the next sort of few weeks, few months in terms of yields and all that, but definitely one worth keeping an eye on because it's back at those March lows. And if we do realise that yields are not going to climb, CSL could give you a bit of a return.
So we'll be watching the bond market very closely. Do we have one for Macquarie? This is your favourite, isn't it?
Yep.
Why do you like it?
So look, it's a very interesting chart, this one, and it's one that we've been picking up again recently. What I like about the way Macquarie's trading is the way that price action's just stepping on top of itself, so sort of like a set of stairs. So what I've tried to indicate here in the middle of the chart, from November to about January, February, we had this tight trading range. It did break down briefly, looked very negative, but then they gave the market a trading update. So the market was expecting. So
the market was basically wrong, but
just so that's the way it is. So the market was previously Macquarie guided for a decrease in earnings growth, and they came in and said, okay, well, we're actually expecting about 5 to 10% from memory. So the shares shot up, consolidated on top of that initial trading range, and then we can see in the last few days it's popped up again. So very nice sort of, stepping up of the price range. And look, in the last few days I've been buying more Macquarie. So look, this is my pick for the moment. I think there's further upside in Macquarie here, and I think over the next few months you'll see it continue to kick on to new highs.
The next thing we'll be asking is when will Macquarie break 200, mate, the way it's going.
Yeah.
Did I ask you about Altium? I don't know if I did.
Yep.
I did. Okay,
Yep.
so we must have a slide there for Altium.
So
ALU.
Yeah, so with Altium, what's interesting is that the share price is all the way back down to those March lows. So sort of like CSL, it's retesting those lows. I can see over the last few weeks it's been getting a bit of buying pressure every time it heads down towards where it was in March. So that is a positive, but again, in the last sort of several months we do clearly have a bit of a downtrend. So I think it's still too early to buy a stock like Altium, and it's very susceptible to what's happening with bond yields. So
and it's a tech stock as well. And
yeah,
every time the bond yields go up, really undoubted tech stocks go down.
Yeah, that's right. So look, at the moment it seems to be trying to find some sort of support. At best, it maybe spends a few months showing us that there is support here. But yeah, look, I think it's too early. Look, it could bounce from here, as I said, near the March lows, but for me it's just a little bit too early.
Before we wrap up, and this is a question without notice, Michael, but I know you don't only just look at the technical analysis of a company. I've been thinking that there are companies that have been lumped in the tech sector, which aren't classic tech sector. Now, Altium is, that's what I said, is an undoubted tech company. It's software, it needs big companies to invest in it. We know that the Silicon Valley problems haven't been great for Altium, and because other big companies weren't actually, But there are some tech stocks which aren't really, like Apple's not really as much a tech stock. It makes stuff, it sells stuff. It's a retail stock really, isn't it? But it gets lumped in the tech thing. Do you think there will be some kind of rationalisation? And I'm thinking like Xero really is a business stock, and as business gets better, I'm kind of assuming a lot of CFOs and business owners say, oh yeah, it's about time I bought some stuff. But during the coronavirus period, I don't think there was a real rush to buy that sort of stuff, unless it was labour replacing technology.
Yeah, it's interesting. I suppose you've got, the company that springs to mind is Tesla, and that's, is it a manufacturer?
It's a car maker.
Whereas a company like Xero, obviously they have their software, and I just picture these. I suppose the classic tech company is a business that, most of the costs are fixed, and to increase their revenue, they don't really have to increase their costs. They just add all these extra. People.
Tesla's a better example. Yeah, you're right on.
Yeah, so when you compare that to someone, a company like Tesla, they need to churn out more cars, whereas Xero just doesn't have to do anything extra. They just sign up a few more extra people, and they don't have to increase their cost base. So I think it comes back to, for the extra incremental increase in revenue, how much do you have to increase your costs, and you get a different story
and that's why
there.
I kind of think that the reopening of economies will make a lot of business owners and CFOs, who often say no to spending money, to start thinking, well, maybe the economy's booming. I think that's going to be the case over the course of 2021 and 2022. I think those sort of companies may well have the upside that might surprise many of us. Michael, thanks for joining us.
Thanks, Peter.
Mike Gable from Fairmont Equities. This is Mike Gable from Fairmont Equities. My next guest is Paul Rickard from the Switzer Report. And Paul has done a bit of homework on ethical funds, which have actually had a very good track record, at least reaching back the past decade. But he reckons he's got some unusual or some unique observations. Paul?
Yeah, they have had a pretty good record, Peter, although I think last year's been a bit tough for some of the funds. I might come back to this and just tell you about what sparked my interest in looking at ethical funds again, because they are on the rise. And last week, Beta shares launched a new ethical fund under the code of ERTH, which is about climate change and
Earth. They're good at their names, aren't they?
They are excellent on the four-letter names for the ASX code. Look, not disputing what this fund is going to do, I looked at the holdings of the fund, and coming in third place was Zoom, the communications company. Okay. And I was wondering, how does Zoom qualify
as an ethical company? Yeah.
Well, in terms of climate change, and I guess fewer people are travelling and we're more using video conferencing. But I think it does highlight. You do need to look sort of under the bonnet of some of these ethical funds, and that's really what my research sort of found out. I looked at the leading 4 funds trading on the ASX. These are listed ETFs, and really there's a great deal of variability. What's interesting, Peter, is that they sort of have a 2-step process, and they're all based on usually some sort of index from a recognised provider. But the first step is the so-called negative screeners. I think we can all understand those.
So screening companies that have some negative problem that doesn't fit either ESG or, in this case, climate change.
Yeah, the typical type of things like fossil fuels, alcohol, gambling, tobacco, armaments. There's coal. Coal. There's a whole lot of negative things, and most of the 4 funds I looked at have the same negative screeners. Yeah. That's the easy bit to understand. The positive screeners, where they in some cases look at where the company's earning its revenue and say you've got to have at least 20% or 40% coming out of a particular style of industry, or they apply some sort of ESG sort of rating that's been given to them by a certain group, or they look at sort of other factors. They seem to be all over the place and a lot of variability. Let me just give you the example. The biggest fund in Australia is from Beta Shares. It's trades under the acronym of FAIR, F-A-I-R, and it's the Beta Shares Australian Sustainability Fund. About $842 million and growing pretty rapidly. Yeah. Now, when you look at the holdings, they're very different sorts of companies. Their largest holding is actually in ResMed. It's a medical device. It's a sleep apnea product company that we know. Okay. But there aren't any major banks in there, and there aren't any resources. In fact, there's only one company out of the current top 10 that qualifies. So they're really getting down into some of the mid-cap and smaller companies. Right. But I look at some other companies, and another one is from Russell. So they have what's under the code of RARI, R-A-R-I. It has quite a big holding in Fortescue. Another one from Vande, which is the Vande Vectors Msci Australian Sustainability Fund. Its largest holding is in Fortescue Metals. Wow. Now Fair's got 0, and another fund has got 100. Its largest holding with about 8% weighting in Fortescue Metals. Some of them have big exposures in the big banks, and others say no, we're happy with the regional banks and the insurance companies, but we have no major banks. So, for example, the one I mentioned up front, which is Fair, it has regional banks, Suncorp and Bendigo, but doesn't have any of the 4 majors in the fund.
So I guess Bendigo would qualify as a community bank, and they probably don't lend to the big miners. Some of the big 4 banks have been put offside with ethical funds because they do lend to the miners, particularly coal. Yeah,
so there are those sort of question marks, but look, it does mean you do need to look pretty carefully because they're very different. Just to look at the composition of their top 10 and their index breakdown will just show you how they've been put together. So the negative screeners, by and large, the same. Yeah. The positive screeners, which are a lot more subjective, do vary greatly from fund to fund. So that was the first thing that sort of made me wake up, and really the lesson I learned from that was that if you're thinking about investing ethically, have a look at what it invests in and how it got to that decision, right? Yeah. That's really important. Okay. The second was about performance, because you and I have over the years had a lot of work to do with some of there's a Responsible Investment Managers Association, and we've heard the story about performance. They do as well. In some cases, it's been argued to us they do better than the normal equity fund. Well, certainly over the last couple of years, that's not the case. All of these funds had underperformed in the last 12 months, quite badly, gap of up to about 6%. And over 3 years, we're still a little bit behind, and over 5 years, we're still a little bit behind as well. So the gap wasn't quite as big, but when I say underperformed, I'm comparing it if you just had an investment in the index, the overall ASX 200 itself. So comparing, the ethical fund there and a normal fund that's investing in all of market, right?
Like an ETF.
Like an ETF, iShares,
and that's a fair way of comparing it, because you're not necessarily saying they're not giving you a good return because the return on the market's been pretty good, but it's just not outperforming. That's what we thought ethical funds were doing.
Yeah, in fact, they're underperforming a little bit. Now, that's data over 5 years, and maybe if you go back over 10 years, it's a different situation. But they have particularly underperformed in the last year. And there's really pretty easy explanation is because you've had a great performance from BHP and Rio and some of the other so-called, the carbon-intensive companies because the oil price has gone through the roof, right?
Yes.
And also you've had a pretty strong performance from the major banks, and a lot of them only have a small exposure in the major banks. So when you get sort of the big the big miners plus the major banks, you throw in Woolworths, who's done it pretty well as well.
Yeah.
And that's none of them have Woolworths because of their holding in the
business,
the hotel and the poker machine business. Yeah. That's why they've underperformed. So I guess the moral of the story is it's great to be an ethical investor, but you do have to look A, at what you're investing in, and B, I just think there's a performance trade-off, and we want to see how that plays off. Now, there's probably a better argument for investing overseas than there is locally in ethical because there's just a bigger pool of companies, Peter, and arguably better developed. But that's maybe a story for another day.
Yeah. One last question, Paul. Do these ethical funds pay a reasonable dividend?
Yeah, look, they're okay. The market dividend, in fact, one of the funds from Russell, that's Ferrari, actually sort of accentuates the income side. So they're paying a pretty good distribution. They've got the worst overall performance, but they've actually got a big income distribution. They've been paying around 6%. And that's, again, because of the concentration and the style of company they're investing in. So from an income point of view, you get about market. But again, if we just look back over the last 12 months, the best dividends are also coming out of the miners. So they're probably just a little bit short. But over time, I think you expect that to neutralise out.
All right, so you've looked at the funds on the market. What are the ones that people should think about?
Well, the one I'd probably invest in is the newest fund, but probably with a more established index. That's from Vanguard. It's code VETH, which is the Vanguard Ethically Conscious Fund. That's just VETH. So I think Vanguard and ETH is sort of ETH for ethical.
Yeah, ethical,
so it gives you the four-letter acronym VETH. Yeah. You've got to get an acronym that people got to remember.
Well, you do remember them, Beth, like IOZ is iShares Oz.
And I'm sure Beta Shares puts more. No, they're being unkind to Beta Shares. They put a lot of thought into their acronyms. They have the best acronyms. I have to. We always say that about Beta Shares.
Have they got Robo as well?
Robo's from ETF Securities, but Beta Shares has got some other really terrific ones, right?
Yeah, that's right.
So VETH from Vanguard, management fee of only 0.16%. It's going to track an index from which is coming out of FTSE or the FTSE, Financial Times Stock Exchange people. Pretty broad-based index. That one's really only a negative screener index. And I think that's probably a little bit safer than maybe some of these positive screeners because you've really got to agree and like what they're saying. Because I found it a little hard to, as I said, to understand some of the thinking behind how they were positively screening companies.
One last question, and a lot of the viewers might be thinking this. Even if the funds don't perform all that well, but society becomes more enamoured with the idea of ethical funds, the very weight of money going into those funds could push up the unit price, couldn't it?
Absolutely, and I think that is a long-term risk of investing in, you could argue, in your BHP and your Rios. Yeah. It's certainly a long-term risk of investing in a coal company now, probably a more medium-term risk. It's why Woolworths, for example, is getting rid of its hotels and poker machine business.
And Dan Murphy's will be setting up.
Which is largely because of the issue with poker machines. So that's why Woolworths is currently excluded. When it does that, the existing Woolworths of the supermarkets and Big W, that'll be eligible back for some ethical funds. I mean, I don't think ethical investing is going away, and certainly the way that major superannuation funds look at, put a very high weighting on ESG type issues. I think that force is here forever. So I think as investors, we need to be cognizant of. So you do need to know what other people won't invest in. That's got to be one of the inputs you take into consideration when you invest in a particular company.
Yeah, very good and very ethical report from you then, Paul. That's Paul Rickard from the Switzer Report. And that was Paul Rickard from the Switzer Report. Now, just a little heads up, the Thursday Property Show is now going to be called the Investing and Property Show, and we'll be bringing a lot of investment tips for the market for you. So make sure you join us, and we'll spotlight the major property story of the week as well. So make sure you join us on our YouTube channel on Thursday.